Hey guys, what's going on? Welcome back to another video. So when I first personally started investing, I had a lot of questions such as what do you exactly need to look for and how do you find good stocks to buy? I don't know if it's just me, but with a lot of the online articles and videos that I saw years ago, it didn't really help me too much and I didn't really understand at first because they didn't go into detail and explain step by step, but most importantly, they didn't give the reasons or explained what gave a stock its value and made that stock worth buying. So today I want to teach investing as if I was speaking to a 15-year-old version of myself, and I really wish I had seen a video like this 5 or 6 years ago to get me over that fear of just getting started up investing in general, because most of the things that I heard with investing when I was a lot younger tended to be more towards the negative side, such as stocks are too risky or investing is too risky because you can potentially lose all your money. Because if I had started investing a lot earlier than I did, I probably would have a lot more money than I do as of today. I've always liked money, and ever since I was a little kid, I would save up and hoard all my dollars just to see exactly how much I can save up and feel as if I were rich. And my main side hustle in high school was just buying and reselling limited sneakers and apparel. And I remember I was like 15 or 16 years old at one point, and I had like $3,000 saved up. And I really wanted to start getting invested into the stock market or into some stocks or bonds or something, but I didn't really know exactly where to start or how to start. So as of today, I'm 21 years old, and if I had originally invested that $3,000 into like a broad index fund such as the S&P 500 that tracks 500 of the largest companies whose stocks either trade on the New York Stock Exchange or the NASDAQ, which gives you more variety instead of just picking and investing into individual stocks, and at an average return of 10% per year, as of today, I would have roughly $4,800. It doesn't really sound like much, and I can already hear you guys saying things like, why would I invest $3,000 or over the course of 5 years to only make $1,000? That's so boring and that's hardly any profit. Yeah, but this is why you invest consistently and you make contributions on top of your initial investments to see your capital exponentially grow. Whether you invest more money every single week, month, or every single year, by doing so, you're gonna start seeing your money grow at a faster rate than normal. If I had contributed an extra $100 every single month on top of my initial investment of $3,000 when I was 16 years old, as of today, I would be sitting at almost $13,000. Sounds like a lot more money, doesn't it? So when I realized this, a switch just kind of flipped in my head and made me really passionate and really wanted me to start making investing a priority, because I kept telling myself, if I had started investing 7 or 8 years ago and put as much money as I can every single month into safer investments such as index funds, I would have this amount of money today. And if you find any value in today's video, all I ask for you to do is hit that like button. It helps me out tremendously to continue making videos such as this one. So over the past 10 or so years, we just experienced the longest bull market in stock market history. And chances are, as of right now, if you pick stocks at random, you're going to have a good chance of making money in the short term. But this is exactly why you should be extremely careful when looking for individual stocks to pick. I myself still buy individual stocks and go off my research and valuation for individual companies, but with index funds such as VTSAX, which stands for Vanguard Total Stock Market Index, right now one share of VTSAX is trading for around $72.80 per share, and by owning one share, you have spread out that $72 amongst over 3,000 publicly traded US companies, as well as having exposure to the international markets. So all you have to do is keep buying this fund every single week or every single month as much as you can, and chances are in the long term you will have a better chance of beating 90% of people's stock market portfolios due to the massive diversification within these funds. And that's just how the stock market works. So as of today, I still like picking and buying my own individual stocks because I like doing my own research to see if I could construct a portfolio that will beat the market in the long term. And you don't have to be smart or super intelligent to become a good investor. I personally think of myself as an average investor, and I really wouldn't recommend going to a professional stock picker or fund manager and expect to get amazing results, because all they're going to do is build a portfolio that's similar to an index fund that you can get the same results in yourself, and you're going to save a lot of money from fees and commissions that fund fund manager would be receiving from you buying and holding onto their fund. So now let's flip the script so I can show you guys exactly how to pick good individual stocks. I'm also going to provide some websites as well so you guys can look at some of this data and info. And quoting Warren Buffett here, the stock market is a device to transfer money from the impatient to the patient. So basically anyone can make money in the stock market, but the only way to make great money is through long-term value investing. Just my recommendations. Let's forget about trying to day trade or penny stocks or swing trading or options trading. And when looking at a company, there's two sides. There's going to be quantitative and qualitative analysis. I am sure you have all heard the quote, men lie, women lie, numbers don't. And that is exactly what an investor looks at through quantitative analysis. They're going to look at a company's numbers to determine exactly how much that company is worth. Because yeah, you can just Google a company's stock price such as Microsoft or Tesla and it will give you a number, but that's not the real number of what that company is actually valued at. That number is mainly based upon rumors, speculation, and news that surrounds the company, because quantitative analysis is going to examine a company's balance sheets, income statements, and many other factors, and these are basically the fundamentals of a company. This is why many investors often sell a company's stock if a company's fundamentals change and they do not like where the company is headed towards in the future. You can use a free resource such as Yahoo Finance to look at a company's data. This is a free site which is especially great if you are a new investor and just starting to get the hang of things, so you don't have to spend too much money on online resources. And if you would like to go into more detail about quantitative analysis, I highly recommend checking out the book The Intelligent Investor by Benjamin Graham. It will go into a lot more depth and detail about quantitative analysis. So now on the other side, we have qualitative analysis, which focuses on a company's qualities that make it great and not so much about the numbers. So what I like to do in a situation like this, if a company is cheap or at a discounted price in relation to its qualitative value, which means that the company is trading lower than what it has historically been valued at. This is often what Wall Street does. Companies rarely trade at fair value. They either really overvalue or undervalue a company. And an example of this was around this time last year. Tesla was trading at under $200 per share, and I believed it was highly undervalued. Then leading up towards the end of 2019, when Tesla started coming out with better earnings and better news, and they were able to keep costs low and margins pretty big, Wall Street decided to get really bullish on Tesla, and it drove the price all the way up to over $900 in the span of just 8 months. That's almost a 400% increase. And now you may argue that Tesla may be overvalued for what it is actually worth, because fair value for Tesla is somewhere around $650. And I know this because of a paid premium service I used called Morningstar. And this is great to go into more depth about qualitative analysis, which will help you determine if a company's stock is expensive or cheap to buy at the given moment. So if there is a company that you liked and bought at $100 and it is now trading around $80, you should love it at this price based on qualitative analysis, right? Correct. You also need to keep in mind when diversifying your portfolio, you should limit no sector to more than 20 to 25% of your total portfolio's value. And some more questions you should be asking yourself when looking at a company's qualitative analysis is this company's business model boring? If yes, then that should be a pretty good indicator. And some more questions are, do people need to repeatedly keep buying products from this company, like toilet paper and tissue? Then yes, that would be another good indicator, opposed to a company like Ford that has to continue to keep finding new customers to get behind the wheel of one of their vehicles, because how many times do we buy a car in our lifetime? Only a couple, right? And that's it. A great book that I would highly recommend that goes into more detail on qualitative analysis is a book called One Up on Wall Street by Peter Lynch, because when trying to determine what is going to be a better factor to base your opinion on to buy a company or not between qualitative and quantitative analysis, it is still going to be about a 50-50 chance. So over the long term, it is best to look for companies that are well diversified and provide great value. So when using both of these to examine a company, ask yourself, if I buy this undervalued stock, I might not make that much money in the short term, but I can't lose much more value than I paid for it over the long term. So when valuation finally catches up with the stock price and the stock price goes up, this is how you can make money on this company, because this is how you're gonna take on minimal risk and you're gonna give yourself a good chance to profit off of this company in the long term. So that's gonna do it for today's video. Remember to use the link down below to download Robinhood and claim your one free stock. It is absolutely free to sign up. And if you guys enjoyed today's video, please drop a like to support the channel, as well as hit that subscribe button with that notification bell to not miss any future videos like this one. I hope you guys have a great rest of your day, and until next time.